Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Implementing Financial Management Techniques. Implementing financial management techniques is crucial for aligning an organization's strategy with its financial outcomes. Effective financial management is essential for achieving the long-term goals of any business. This process involves the planning, organizing, directing, and controlling of financial activities such as procurement and utilization of funds. To ensure that financial management is effectively integrated with business strategy, a variety of techniques can be employed. These techniques enable businesses to make informed decisions that support sustainable growth and profitability. One of the primary techniques in financial management is budgeting. Budgeting involves creating a plan for how an organization will spend its resources over a specific period. According to Horngren, Datar, and Rajan, a well-structured budget helps ensure that resources are allocated efficiently and that financial goals are met. This technique allows managers to forecast future income and expenses, providing a roadmap for financial planning. Budgeting also aids in performance evaluation by comparing actual results with budgeted projections, enabling managers to identify variances and take corrective actions. For instance, a company might allocate a specific budget for marketing activities, and by monitoring the actual expenditure against the budget, the company can determine if it is overspending or underspending in this area. Another technique employed in financial management is cost management. Cost management involves identifying, analyzing, and controlling costs to ensure that they align with the organization's financial strategy. Kaplan and Atkinson emphasize that cost management is vital for maintaining profitability and competitiveness. Techniques such as activity-based costing and lean accounting are utilized to manage costs effectively. ABC assigns costs to activities based on their usage of resources, providing more accurate cost information. Lean accounting focuses on eliminating waste and improving efficiency, which can lead to significant cost savings. For example, a manufacturing company may use ABC to determine the true cost of producing a product by assigning costs to various activities such as materials handling, production, and quality control. This information helps the company identify areas where costs can be reduced without compromising quality. Capital budgeting is another essential technique in financial management. Capital budgeting involves evaluating potential investment opportunities and deciding which projects to undertake based on their expected returns. According to Brealey, Myers, and Allen, capital budgeting techniques such as net present value, internal rate of return, and payback period are used to assess the viability of investment projects. NPV calculates the present value of future cash flows generated by an investment, subtracting the initial investment cost. IRR is the discount rate that makes the NPV of an investment zero, indicating the project's expected rate of return. The payback period measures the time it takes for an investment to generate enough cash flows to recover its initial cost. For instance, a company considering the purchase of new machinery would use these techniques to evaluate whether the investment would generate sufficient returns to justify the expenditure. Cash flow management is another critical aspect of financial management. Ensuring that an organization has sufficient cash flow to meet its obligations is essential for maintaining liquidity and solvency. According to Gitman and Zuter, effective cash flow management involves monitoring cash inflows and outflows, forecasting future cash needs, and maintaining an optimal balance between cash reserves and investments. Techniques such as cash flow forecasting, working capital management, and cash conversion cycle analysis are employed to manage cash flow effectively. For example, a company might use cash flow forecasting to predict future cash needs based on historical data and anticipated changes in revenue and expenses. This information helps the company plan for potential shortfalls and avoid liquidity crises. Financial ratio analysis is another technique used in financial management to evaluate an organization's financial performance. Financial ratios are calculated using data from financial statements and provide insights into various aspects of an organization's operations, such as profitability, liquidity, and solvency. According to Brigham and Earhart, commonly used financial ratios include the current ratio, debt-to-equity ratio, and return on equity. The current ratio measures an organization's ability to meet its short-term obligations with its current assets. The debt-to-equity ratio assesses the proportion of debt used to finance the organization's assets relative to equity. ROE measures the profitability of an organization by calculating the return generated on shareholders' equity. For example, a company with a high current ratio may be considered financially healthy, as it has sufficient assets to cover its short-term liabilities. Conversely, a high debt-to-equity ratio may indicate that the company is heavily reliant on debt financing, which could pose a risk to its financial stability. In addition to these techniques, financial management also involves risk management. Identifying and mitigating financial risks is essential for protecting an organization's assets and ensuring long-term sustainability. Techniques such as value at risk, scenario analysis, and stress testing are used to assess and manage financial risks. VAR quantifies the potential loss in value of an investment portfolio over a specified period, given a certain level of confidence. Scenario analysis evaluates the impact of different economic scenarios on an organization's financial performance. Stress testing assesses the resilience of an organization to extreme but plausible adverse conditions. For example, a financial institution might use stress testing to evaluate its ability to withstand a severe economic downturn, ensuring that it has sufficient capital and liquidity to continue operating under such conditions. Integrating these financial management techniques with business strategy requires a comprehensive understanding of the organization's goals and the external environment in which it operates. According to Porter, aligning financial management with business strategy involves ensuring that financial decisions support the organization's competitive advantage and long-term objectives. This alignment can be achieved through strategic planning, performance measurement, and continuous improvement. For instance, a company with a strategy focused on innovation and growth may prioritize investments in research and development, using capital budgeting techniques to evaluate potential projects and ensure that resources are allocated effectively. In conclusion, implementing financial management techniques is essential for aligning an organization's strategy with its financial outcomes. Techniques such as budgeting, cost management, capital budgeting, cash flow management, financial ratio analysis, and risk management provide the tools needed to make informed decisions and achieve long-term goals. By integrating these techniques with business strategy, organizations can ensure that their financial activities support their competitive advantage and sustainability. This integration requires a comprehensive understanding of the organization's goals, the external environment, and continuous monitoring and improvement of financial performance. The effective implementation of financial management techniques ultimately contributes to the success and growth of the organization. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.